Hello, everyone. I'm Donna Holly, the president of the Investment Institute. And on behalf of Andrea Diggothy and myself, we welcome you to our 8th Coffee Break series session. To our TII community, we know it's nothing like seeing you in person, but seeing all of your names pop up onto our Zoom screen provides quite a bit of joy in the meantime. And we thank you so much for continuing to log on for each of these sessions. And we cannot thank you enough for spreading the word as you have. We have more newcomers than we've ever had on this call. And to you newcomers, we welcome you and we would love the chance to get to know you. If you'd like to set up a Zoom or a call, Andrew and I would love to get to know you and tell you more about us, so please feel free to reach out. It is with very heavy hearts that we have to say that due to the current state of the COVID-19 virus, we have decided to take our October 26th, 27th in-person open-air forum to a virtual format instead. While we hate to not see everyone in person, we just want to put everyone's health and safety above all else, and we just don't want to take any unnecessary risks. And it was a hard decision, but we really had to make it this week so that we can move forward with our new plan. We will follow up with all of our members regarding forwarding your membership to 2021, and we'd like to invite all of our members as well as our non-members to participate in this virtual event that we will be doing on those same dates, October 26th and 27th. We are super excited about the speaker lineup and the topics, and we also have some plans in place to help orchestrate in-person dinners in each of the cities where several of our members are. So all of you who are members, a lot of you have expressed the desire to get out of your homes and out of your small offices and get out to see colleagues in person. We are going to do our best to facilitate some very small group gatherings for you all the night of the opening of that conference, so you can get together, talk about the sessions, and just maybe be out a little bit, but not being at a big conference. We're also working on some one-on-one meeting setups around the dates of the conference so that we can connect asset owners with our manager members who have been supportive, so supportive of us through this whole year. And we just want to thank you all and do as much as we can to accommodate the things that you've requested that would be useful. Andrea will provide more detail about all of this at the end of today's webinar, but we just wanted to give you a little sense of it for now. And now on to today's session. David Fiszel is the founder and CIO of Honeycomb Asset Management, and many of you know him from his Omega Advisors and Point 72 days. Mark Steed is the CIO of Arizona PSPRS and one of the stars truly of our TII editorial committee. If you are having one of those days, you are in luck. But these two fireside chatters are honestly a joy to behold. We so enjoyed our prep call together, and we know you will too. We're really excited to hear what they have to say about trends accelerated by COVID-19. A few quick logistics before we get started. Please take a moment to find the Q&A button on your Zoom screens. And during the session, as soon as you have a question, please type them in. Mark will be reviewing them throughout the session, and we'll try to incorporate as many as he can throughout today's program. You'll also receive an email at some point after this webinar with a link to our recordings for this, as well as our prior recordings. And we will also include the link for a short survey. We beg you to please fill out the survey. We really, really value your input. It means a ton to us. For those of you interested in receiving CPE credit, please be sure to listen in for the entire session live today. You can reach out to admin at theinvestmentinstitute.org for the necessary paperwork to complete after the session. And with that, Mark Steed, take it away.
Terrific. Hey, thanks for the introduction. It's an honor to be here and to be associated with the Investment Institute. I am excited today to be speaking with one of my favorite CIOs, David from Honeycomb, and that's because we are investors in Honeycomb, in full disclosure, and he makes money. So therefore, he's one of our favorite CIOs. So we've got some material that we're going to cover today. We're going to talk about trends that have been sort of exacerbated by COVID-19, which I'm sure everybody's happy about. And I just want to wish everybody a happy Apple $2 trillion market cap day. I think it was trading at 400 plus last time I looked at it. And I'll be donating 400 apples, fruits to Honeycomb in honor of that day, David. So anyway, I'm happy to be here. I'm going to try to field questions, but David, let me turn it over to you first. to just introduce yourself and Honeycomb, and go through sort of your mission and background, and then we'll jump in with some questions. I'm going to do my best in full disclosure to the audience, as we're all dealing with, sort of workarounds here with COVID, to get to your questions. I might not be able to read all of them. I might summarize if there's several questions that sort of have to do with the same type of, the same subject. Please be patient. So with that, David, why don't you introduce us to yourself and Honeycomb?
Great. Thank you, Mark. And thanks to the folks at TII. You guys do a great job, and we're very happy and honored to be a part of it. Giving education is really important, and doing it at a time when there's so much change going on in the world, I think is very valuable. So we do a lot of research at Honeycomb, and being able to share it in a forum like this, I think is just helpful. And so our mission at Honeycomb is to invest in the future and to short the past. And we're a mission-driven culture, and we've been trademarked that so we could really be on point all the time. And that leads us to many different areas that I think is a little bit different from many sort of TMT folks. And we really think of ourselves as a creative shop. We are very much part of what is the next thing, and there's always something new. Technology is always changing. And what I thought would be really interesting to talk about is how COVID has really impacted some of this change. So we can go into that. My background has always been investing in disruption, always been investing in change. And I've just seen it from early days in cable and media and telecom to wireless to internet. And now, of course, we have it across many, many segments that I'd love to tell you about, whether it's payments, public cloud, fitness as a service, broadband, cable. We're going to cover a lot of.
Yeah. Yeah, that's great. I appreciate that background, David. And I'll add that, as I mentioned at the start, that we're investors in Honeycomb, just in full disclosure. And one of the things that the way our organization feels about a lot of growth in technology is that it's very organic, it's very dynamic, obviously, but you can't use sort of traditional sort of financial metrics that we all like to use, DCFs and et cetera, when you're really trying to gauge, probabilities and terminal values of companies. And I just thought, sorry, I think we got some feedback from, there we go, I think that took care of it. Anyway, so I think there was some good, between organizations, sort of a shared mindset there. And so I think it would be helpful for everybody to just sort of start with your core outlook, if you will, right? And to talk about, let's start with, you mentioned payments, let's start with that. I think one big area, and we'll go from there.
Yeah, look, I think that contactless payments is something that was a trend that was already in place. Yeah. And, what you'll see and what you'll hear about in the months and years to come is how COVID accelerated so many trends some that were already in place. And not touching cash obviously helps not spread disease, but it's also more efficient. And it's certainly one of the ways that China did such a good job of stopping the spread of COVID by going to QR codes and not having contact among money changing. And so here in the US, that has been a trend, but it really only growing 100 to 200 basis points a year, not accelerating. And in fact, in the United States, cash is still 40% of the transactions. So what we've seen during this period is that that's dramatically changing. And we've certainly structured our portfolio to take advantage of that sell-off that happened mostly because of the recession, not because of the change in the secular shift. And so we look at that on a global basis. And in fact, one country, the first country actually that really showed us the way was Italy. Italy only has 26% of credit card payments as a method of payment, and the rest is mostly cash. And so the government there did a lot to encourage people to use contactless payments by not only giving merchants a tax benefit to getting the point of sale terminal, but also creating a national lottery that every time you use a digital way of paying, you kind of got a ticket to win part of €1 billion jackpot. So we're seeing that pick up. I don't think it'll be the way it happened overnight for like India. You know, in America, we love our frequent flyer points. We love our rewards programs. And so, you know, going completely to skipping over credit cards, I don't think will happen anytime soon. So we really are quite bullish around the payment processors, and we will get a rebound eventually in the economy. And so payments will kind of eat into that cash portion of how transactions are accomplished today. So we're
Yeah, and can you expand on that just a little bit? So, like, talk about sort of like the ecosystems, right? So you have, you know, you have like the Visa and the MasterCards of the world, right? And then you've got Square, and I know I'm making payments on Venmo now. So talk about how you view the ecosystem, maybe.
Look, I think that cash is going to the Venmo peer-to-peer type of transactions, where you're not getting on the rails. The merchant's not taking a piece of it right now. Where, you know, you're paying your babysitter, you're paying your hair, you know, the person who cuts your hair.
Yeah.
This is accelerating so fast. So we look at that cash app was really what Square's providing, what Venmo is providing. You know, one company that I was wrongly negative about until we did more work, which is in Australia, which we own, is called Afterpay, and they've completely changed how you even think about payments. So what this company does is they said, look, we focus. Sorry, let me back up. At Honeycomb, we focus a lot on Gen Z. We're kind of done with millennials. That's kind of well trodden path, and everyone knows what they're up to. And their work ethic and all that great stuff. But Gen Z, you know, is really important, and they're very budget conscious. You know, their parents were in the great financial crisis, and they don't believe in paying the man the 18% VIG on the credit card bills. And so when they go to a purchase, that $100 purchase, they view it as four $25 purchases, and they demand that they use something like Afterpay. And what Afterpay does is they only charge you $25, and it's a direct debit, so it never even hits a credit card. And so they'll take it right from your paycheck every 2 weeks. And that's an amazing way of turning over the amount of velocity of lending, basically. And so Afterpay's on the hook for that. And the merchant pays Afterpay 2 to 4%, and they would have never gotten that sale. So one of the things that we love is when the consumer drives the adoption, right? And so whether we saw this 10 years ago with Facebook or something like that across college campuses, if you go to Twitter and you look at Kylie Cosmetics, you know, one of the most popular cosmetic brands, the Twitterverse was saying, when will you take Afterpay? I want to Afterpay this purchase. And they're using it as a verb. And so they have to break and they have to use it. And so that company is growing by leaps and bounds, and just launched 18 months ago in the United States. It already has 5.6 million people using it. So they think of themselves as more of a budgeting tool, and really just taking a leap over even credit cards. So we look for this buy now, pay later, which you and I would have called layaway. And there's a couple of different companies doing that. And it's just, it's amazing. It's no credit approval. You would think there's a tremendous amount of risk, but what they do very intelligently is they don't allow you to go buy something like an iPhone that's easily resellable. It's actually lipstick that you're going to use. And so the algorithms are so smart, and they decide who to extend credit to, a little bit at a time, hundreds of dollars of increments. And people are more worried about getting their Afterpay cut than their auto loan being, kind of delayed. So we're seeing some interesting trends there.
Yeah. And so talking, it looks like we have a couple of audience questions about Afterpay since we're on it. Crowded position. So maybe a more general, maybe a more general comment on, how Honeycomb approaches sort of crowded trades, right? I think everyone sort of looks at COVID, and maybe you can respond to the Afterpay specifically. But more generally, I talk about crowded trades because I think to some extent there are lots of people sort of going long, sort of post-COVID businesses.
Yeah, look, I think that this goes back to something we didn't even touch on, which is the Honeycomb investment process. The investment process is really important here. And so first, if we get the secular trend right, IBM was 5% in the S&P 500 in the 1980s. So crowdedness is a little bit of a duration question. Microsoft was quite crowded in the 1990s, and if you didn't believe a desktop computer was going to be ubiquitous, then you probably missed out because of your fear of crowding. For us, we really say that sometimes crowdedness is good, and we're not such contrarian investors that we're looking to be the only guy seeing it. At Honeycomb, we do a lot of research. We look to see what the trends are. People come behind us into a trend and sometimes after us, but everything we do is based on a risk reward. And we look at that every single day. And so for us, we're duration agnostic. We have a fair value of what we think Afterpay is worth, and if it gets there, we'll sell it. We're not here to make a 5-year call or a 10-year call. We're here to do a DCF and come to terms with what we think a fair value is. And in our portfolio, everything has a highest and best use. And so if the stock appreciates faster than where we think fair value is, then we sell it. And so for me, sometimes crowding is a great thing because it gets us quicker to fair value. Other times it's a bad thing, but the way I think about it is the stock down because it's an expectational miss because it's crowded? Or did we lose money because we were wrong? If we lost money because we were wrong, that's really not a crowding problem. That's a Honeycomb problem. And then we'll go and reassess our research and figure out where were we right, where were we wrong, what we have learned. And we really have a great culture where we don't believe there are mistakes. They're just learning opportunities. And we attack the analysis, not the analyst. And so crowding for us, frankly, we're a second inning, a seventh inning player. And crowding tends to be a benefit, not necessarily a detriment to performance. But hopefully we're just right on the trend and we're right on our numbers. And the way I think about it is if I think something is very crowded, then the bar has to be higher. If I'm aware that this becomes a popular, particularly among the long-short community name, then I just want to make sure that our numbers are that much higher, that we're right. Being in a crowded name that's in line, I'm going to lose some money there. That doesn't excite me that much. We should find something better. And so that's kind of how I think about it.
Yeah.
Question.
Yeah. Yep. No, I think that's a helpful way to think about it. And it's moving just a little bit from Afterpay. You talked also a little bit about e-commerce.
Yeah.
So maybe what we'll do is just cover a few of the topics, so a few of the themes that you guys are looking at right now, and we'll have we'll handle some of the audience questions as we go along. But I know e-commerce is sort of another big one for you guys too.
It really is. I know it seems almost silly to say like e-commerce is a big theme, but if I told you it took 10 years to go from 5% penetration to 15 in America on e-commerce, you would say, okay, like that doesn't seem that crazy to me. But what we saw over the last 3 months, and this is from credit card data that anybody can pull from Bank of America, you've gone from 15% penetration to 26% penetration in 3 months due to COVID. So that is just such an accelerant that I think this Christmas is going to be ridiculous, like on an e-commerce basis. When you look at yesterday, for a fact, Walmart, which we don't have any position in, reported a 97% growth in e-commerce in this quarter. So how many people will go back to driving to the store when it's safe and we have a vaccine versus ordering it online and just buying it? And so again, when we talk about accelerating trends, we think that back ends very nicely into payments because, of course, the only way to pay for an e-commerce transaction is not through cash, and it's through payments. And at Honeycomb, we really think of a honeycomb and building the building blocks of a good portfolio tends to build upon each other in an organic, natural way. The trends around e-commerce really go by category. And so one of the things that we know and we see that's important is the categories like home furnishings, which was probably slower to go online, is now quickly accelerating online. And that's
to your point there. One that's maybe near and dear to my heart. We have a soccer team here in Arizona, right, that plays in the USL, which is the second tier of US soccer, and their sponsor is Carvana, right, and you see Carvana t-shirts and there's a giant Carvana vending machine. How do you see that one?
That's exactly what I'm talking about, where, it would have taken a long time to get to comfortable with not test driving a car by going to the car dealer, kind of taking some of the free popcorn, walking around a little bit, and trying to work the guy over a little, and now it's just more efficient to do it through Carvana, right? So these kind of big categories of retail spend, which will be payments, right, which will be e-commerce trends, they really build upon each other. And that is an area where I think over the next 3 to 5 years, we're going to see a lot more growth. So we're pretty bullish around these things. And for us, it's really a question of valuation, not so much trend. Trend is very much intact. One of the things that I think is kind of interesting about where we are with 10% unemployment, unfortunately, is a resurgence of a trend of re-commerce. And re-commerce is something that we looked at in the last recession, where when you look again at Gen Z and what's really important to them, and that's something, again, worth really studying, it's okay to buy a used shirt. It's okay to buy used shoes. It's okay to buy used items. And in fact, there's a sustainability component to it of all the apparel that gets thrown out. These are the things that we're kind of thinking about. And so whether we have portfolio positions that are things like, which we're not currently in, but eBay was a significant contributor to this year, Mark, was because we just, you know, we kind of saw which way things were going, and we know when people want to buy, you know, used health equipment, you know, fitness equipment, like, they save money, and that's a good way to go. And so we think about this stuff and think about how can we see the trend, and then the trend behind the trend, and how long is it going to last, and what's the durability of that trend, and then what's the valuation of the trend. So there's some great companies moving things online faster, things that we would have never invested in before. I'm thinking of a company like Farfetch. You know, luxury has been very slow to move online. They really wanted to protect the brand experience. They really wanted to control the end user. And now there's department stores are really not there for them. So getting that delivered to your door aspect is so important, and having a good experience is important. So releasing more inventory is really important. So, you know, these are some of the things that we see that within e-commerce that continue to be exciting to us.
Yeah, and I guess sort of the elephant in the room here, right, is Amazon. Obviously, they've benefited hugely, you know, from COVID-19. There's a question from the audience about competition for Amazon, and how do you see that? Increase? Are they just too big? And then, as a follow-up to that, you know, can you talk about sort of if you see any potential interference on the political side with the upcoming election from sort of antitrust perspective, legislators stepping in to try to protect consumers, and you know, et cetera, et cetera.
Yeah, look, I think Amazon has about 10% of the retail wallet right now, back into what Americans spend and back into what Amazon's, you know, sales are. I could see that growing a lot over time. They're just they are the best at what they do. And so when I think about competition for Amazon, I think about sort of like riches and niches. So whether it's pet food and Chewy, which does a very good job, you know, or Wayfair on, let's say, home furnishings, which does a good job, even Carvana within cars. So I think you'll just see more marketplaces and things that exist. But in terms of the scale that Amazon has, it's hard to beat, and they're so innovative, you know. So to me, that's something that I would expect to continue to have that competitive moat. So that brings you to the next question of, you know, what's the government going to do about that? It's really, really difficult for me to see the government having such a problem with these companies that kept the lights on the global economy. You know, if we didn't have these companies, we would be back to, you know, the dark ages, right? I mean, whether it's talking about medicines or food or water or milk for your kid, I think that becomes something where I don't know who you're protecting, honestly, where Amazon really has only been fulfilling essential items first. And we have a great relationship with Amazon, and that's a company that, you know, at Honeycomb in our investment process, we can do all the modeling in the world, but we need to talk to our companies every quarter, and we do a quarterly callback. And I think Honeycomb punches above its weight class in being a fund that is a sector expertise. So whether we're invested in it or not, you know, we get the same half hour with the same IR person every quarter, and it's been really helpful over the long haul of the last few years that you've been an investor.
Yeah.
And you'll remember, you know, even I couldn't make it to our investment committee meeting because I was so dialed into what was Amazon going to do on Cyber Monday, and that was a decision I made because that was an amazing opportunity for this particular company. And we pushed it off a quarter because I didn't want to miss that opportunity. And you were very generous with your time, saying, I wish more managers would push me off, but don't do that too many times unless you are going to put up the numbers, right? But,
yes. People overestimate how much I like being in meetings, I guess. But speaking of your conversations with CEOs, they've said some pretty interesting things about cloud, right? and sort of the, obviously we're all working virtually here, or a lot of us are. I've got the pleasure of having, dump trucks, outside my door. So what are you hearing from, management teams about sort of the need for cloud-based services? Because a lot of these sort of COVID themes are themes that we talk, e-commerce, right? Cloud,
Right.
even around forever, right? So what's changing in that area?
I think that this one was probably the biggest wild card during COVID. And I think that my initial view of what was going to happen was wrong. I thought small to medium-sized business is a really important part of a lot of those kind of cloud SaaS customer base. And I thought for sure they were all going to miss. I thought that, no one going to work, everyone staying at home, not picking up the phone. This was going to be a big air pocket in the quarterly results. And the opposite came true. What happened was, what we saw was that companies said, we're going to cut everything, but not the cloud spend. We actually need the workforce to be online. And I think really in March and April, those conversations were pretty much halted. But by the end of May, I mean, it was a directive right from the CEOs saying, hey, we can't be behind here. And if you have not spent your time, effort, and money on investing in how you're getting your workforce to be productive from work from anywhere, you have to do that now. And I think that it took a little bit of time for everyone to figure out how to get comfortable closing a deal on Zoom. What was the getting comfortable with screen share, getting comfortable with, hey, what are the things that you need? Let's negotiate. And getting comfortable with, 5, 7 people being in a Zoom room and kind of going through the different points. But if you think about what the companies themselves have said, from Satya and Microsoft, that says, we've accelerated 2-3 years of cloud transition in 2-3 months. This is the kind of talk that highly credible businesses are now talking about. And so those sales cycles, which I think would have been a very difficult conversation, now you have the use case. If we didn't do this, where would our sales have been? And so to us, I think that creates a really good alpha opportunity on the long side and on the short side, because there are businesses that are slow to adapt. And now, the longer this goes on in COVID, I mean, we talked about what trends are accelerating, but boy, it's been 6 months now. And if you haven't figured out with your IT staff what your budget is for 2020, let alone 21, how are you going to play catch up to your competitor? So I think that we're really going to see the detriment of having a lack of a digital transformational strategy in 21. So there are companies that I think that the market becomes less of a market and more of a have and have nots. And that's a little bit of what we're seeing right now. So we at Honeycomb has transitioned. If you told me that I won't be in the office to be with my team for 6 months, I wouldn't have believed it, right? So now we realize that we're lucky enough to be in a business that we can do that and scale. But many people don't have that same opportunity. Yet we realized, now let's look at our cost structure, just like every company. And, at Google, there was like some unspoken law that you had to have fresh food within 6 feet of every employee. And now they're not, going back to the office till summer of next year. So if you looked at Facebook's profitability, it was astounding, just incredible, 52% EBITDA margins with 12% top line. And so we look at these businesses and we say, when you're no longer traveling, how much of that travel is actually necessary versus not necessary? Yeah. So to me, I think that, the days of the $4 kind bars in every, staff kitchen might be over for a little bit, and every recession kind of comes with its own frugality, but also how we do business is going to change a lot. And so while the recovery may be slow, I think the profitability of our businesses could be quite better. And that's something we're kind of looking at, and we're really asking our companies, our portfolio companies in particular, what kind of cost should we expect that's one time? And you might see, I really enjoy kind of talking about this, because this is really where you get to see how the business makes money. And Lee Koopman was a great mentor to me about how, in order to analyze a business, really follow all the dollars. And so we might have less dollars coming in our revenue, but then we're spending on dollars on COVID. Right, we're spending on 6 feet apart. We're spending on testing. We're spending on all these things, but then we're cutting out all these other things. So how fast do those costs come back? I think it'll take a while. So the incremental dollar could be higher margin.
Yeah, that's an interesting point too. One thing that I think there's a handful of questions here. I think it's been said that success is sort of the start of failure, right? And we're all familiar with FANGs and sort of next generation, right? So as you see next generation, I've heard you before say talk about fitness as a service, which just sounds kind of painful, right? Because those of us that need motivation to get to the gym, don't feel like it's much of a service, like more like torture. But you have companies like Peloton, right? And you have Mirror. So can you talk about sort of views on sort of the next generation of FANG maybe, and what you call fitness as a service?
Yeah, look, let's go back to FANG for a second. These are great companies. We own them, but I think that that's not really where our focus is as much. From 2013 to 2018, if you own FANG stocks, you made between 3 and 5x your money. When we started Honeycomb over 4 years ago, that was the game in town. It was FANG. That was what was important. But what we've really seen in the last 2 years is almost 200 companies that have fully funded business plans, terrific management teams, much faster growth than FANG. And so for us, and how we've kind of separated our research process and even our return stream is how can we focus more on the non-FANG businesses that are $25 billion companies today that could be 50 or $100 billion companies. And so you mentioned Peloton. That is a perfect example of a company that has no number two. It has potentially a global scale, is online, and can do something what Netflix did for Blockbuster Video, which is to bring it back in home and stop the idea of having to go into your car, go make a decision, come back, save time. The one thing that I am always looking at is the same 24 hours in a day and how we're chopping it up and what consumers are spending it on. And so we do a lot of survey work, and we talked about that. And when you survey fitness goers, almost 40%, especially younger demographic, believe cycling is how they like to get their workout. They think it's high impact, it's high energy, low impact, better, feels healthy, and having a motivational one-on-one trainer isn't something just for the affluent, right? Now you can get this for $39 a month. And I think what we saw with Peloton was that I like to look at a lot of different KPIs, and one of them is the Net Promoter Score, which is how likely you are to tell your friend that you like it. And they have a 92. That's right up there with Amazon, which means that their cost of acquiring a subscriber is a lot lower because they have a word of mouth that is valuable. So we look at it and we say, okay, they have 1 million subscribers today. We know there's 330 million Americans. We haven't even talked about them launching in the UK or Germany, but if they get to 5 million subscribers, then it's a $6 billion revenue business. So the $18 billion market cap today looks expensive on 1 million subs, but it certainly doesn't look expensive when we look out 2 or 3 years and how fast they're growing through the pull forward. I think there's a lot of people that won't go back to a gym. Like this is just a better, faster, more efficient way of getting your workout in. Not to mention, when we did all the work around, the average person is paying $50 a month, and that's for that person, and then their spouse is paying $50 a month. The average Peloton user has 2 people using it. So you can start getting into it and seeing there's a payback model that actually makes sense and is good value. Plus they're adding yoga and meditation and all these other boot camp classes. So they're going to continue to add value to the bundle. And it was so confusing for us at Honeycomb in January. This was the most heavily shorted stock in the NASDAQ, Peloton. Okay. And, we like to think of ourselves as lovers, not fighters at Honeycomb, but this one we held the line on. And so when we think about, FANG's really important, Peloton was a lot more important to our year than FANG stocks. So that's the way we think about it.
Yeah, and I guess, and how do you see what would you say the differences between like a Peloton versus, some of the other companies that have showed up on sort of like the fitness, like the GoPros or Fitbit, right? Where
I think. No, look, I mean, really, we look at it as a secular trend. In fact, we do public and private, and femtech is actually an important trend. And we had invested privately in Mirror a year ago, and that was taken out by Lululemon for $500 million in June. And so we just saw this as a category that was interactive, which GoPro, Fitbit, not interactive. Okay, you need to be able to, not only, have an ability to kind of see what you want, but then change your content, like your content, be able to curate your own kind of class list and just more control. I mean, the consumers want what they want when they want it. And if you follow that mantra, you can find your way to a lot of profitability. And so we really believe in that trend. And again, the years of, Peloton, I think, has almost 1,200 software engineers. So you're looking at it, and if I tell you about the product pipeline there, whether the treadmill that you're going to see that will be able to move up and down with the hills of Costa Rica that you see is just, it's like when you were on a treadmill 15 years ago before it had a TV on it, when you were at a hotel. So I just think that, I saw one demonstration of an avatar that is running in the Boston Marathon with your time above you. So you can run with like 1,000 people like around you, just different ways of doing things you never saw before. So I think that when you're invested in market leaders, that's one thing we liked about Spotify, when we had done that private co-investment, for our LPs. And I think that we see those things and they're not often, but when they come, I think you just got to try to, really understand them and make a good point of them. Yeah.
Well, yeah, I agree with you. Sometimes what's better than working out is watching somebody else work out. But sometimes I wanted to ask you about, you mentioned Mirror, right? And Spotify. And, we see other tech funds that we're invested with or growth funds, right? That also have sort of like this private angle, right? And following the companies that are sort of venture backed or private, not publicly traded, and then now they're public or they're acquired. So can you talk about sort of why it's important to have sort of a view of a company while it's private and how you do that when you're not necessarily raising have a venture fund or a private equity fund, and then making the decision to own the acquirer maybe, do you stay in or you just take your chips off the table at that point?
Yeah, look, I think that this all comes down to the research process. And so for us, it's quite an organic process. We cover the telecom providers, right? That is part of what our mandate is. And so there was something that happened in the telecom space where they went to unlimited data plans. Okay. So at Honeycomb, the common sense portfolio is the first most important thing that we do here. And so we said, well, who does that impact? Who's it benefit? And we knew it benefited Netflix, but we saw that it benefited Spotify. Okay. Once music streaming became all inclusive, then we saw usage go up and we saw listener hours go up. And then we pulled data from Nielsen. We see Nielsen listener hours are up 8%. So I'm thinking there's the same 24 hours in a day. So obviously now it's cheaper for people. So you've removed a barrier to entry. So when we start looking at Spotify and then we invest in Spotify, we do all this research, we see in the private space, wow, Spotify is using Okta, which is a two-step authentication software company. And I'm just doing my normal due diligence. I'm the Spotify analyst that was private and the, Uber analyst / Facebook analyst. We don't have different teams. We all work on the same things. Being ubiquitous around public versus private, I think on the allocator side, it's more difficult. I think on the public investor side, it's critical. Okay, we have to know what the trends are. I think there's less publicly traded stocks today than there were 10 years ago and 20 years ago. So many of the private companies are very disruptive to the public companies. So here we saw that just doing our work and our diligence on Spotify, we hadn't even made the investment, but we saw that this one software company, which was funded by some great VCs and two guys that had left Salesforce because they didn't believe two-step authentication was a very big market. Spotify is telling us how, oh no, we had passwords stolen in 1 week. The password theft cost us $7 million of revenue. So what this software did really saved us. And then we do more work on Okta, which was a publicly traded company. It was like $34 at the time. And then it turns out that JetBlue says, well, frequent flyer miles are actually not really that protected. And that's actually a currency and bad guys go and steal them. So now we have to protect your frequent flyer miles. So the use cases start building up. There's no chance I would have seen Okta had we not been looking at that holistic flywheel of research between public and private and the alpha that's generated within that. So even though we're 90% public, the 10% that we do private, it really helps inform, educate, create ideas, and all the things that we look for.
Yeah, and going back to that, that's helpful. Going back to the to your positions on sort of like the next generation sort of non-FANG, other than like fitness, the Pelotons of the world, what other areas or sectors or companies are you looking at?
Yeah.
There's I've heard people bring up tiny houses. I've heard people talk about Rocket Mortgage, which is a Detroit-based company where I'm from. What else do you guys look at for fitness?
No. I mean, this is kind of going to be very important. So I want to talk about it, and I want to be like on the record talking about it. I think that conversational AI is really important, and voice search is really going to be a very, very important trend over the next 5 years. And so for us, an important position is Nuance Communications. And you may know Nuance from 20 years ago. They're the guys that do the Dragon Medical, where a doctor talks into a thing and it records its transcription. Well, we did a lot of work around this, and digital health is definitely something that Honeycomb is quite focused on. And healthcare is just $1 trillion TAM, and we love the bigger the pond and the skill of the fisherman is the two things. When they cross, we like to spend a lot of time on that. And so what you'll find with Nuance is their training data is the best. It's very hard to find that many doctor visits that you can train AI on. And so knowing that that's the data set that they have, and it's all HIPAA compliant, completely private, being able to use AI to go through all of these different diagnoses is incredibly helpful to doctors. And so you can get to best practices, better outcomes. And when we did our diligence on Nuance, it was Microsoft that really gave me the confidence that what they had was better than everybody else. So what they're building at Nuance is the exam room of the future. If you think of an Alexa type product that's in the exam room, you will see that that is what it'll be. So you will sign something that is completely like your doctor visit, and it's going to be okay. It's not going to go anywhere, but the doctor won't have to take notes, and it'll get your treatment right. It'll get your billing code right. And in the hospital chains, in our proprietary Honeycomb kind of research primary due diligence process that different hospital chains that we talk to, they were getting 5 to 6 more patients in an hour in an exam room that has what's called ACI or DAX. And so saving doctors that amount of time, it not only helps patients, but helps the whole system. So Nuance is doing that. They've transitioned from cloud to a cloud business, which is growing 40% a year. You can't see it because the old line transcription business is there, but we think that that's going to be a really important business. They spun off another company, which we own, which is called Sirens, and that's automation in the car. Okay, so the exact same technology that records stuff is you'll be able to say, where's the next, McDonald's, or take me to grandma's house, or this kind of stuff. And so the car is the models that are coming out in 2025 are getting, designed today. And so they have a very long lead time of being put into the businesses. And the real competition is Google. And all the work that we're doing, whether we're talking to a hospital chain or talking to Volvo, is they're not so convinced that Google is so friendly. They're not convinced that once you let Google in, that's Google's there. Whereas these companies are more of a white label. Like, we are just the back end, and we get paid with and we just take a percentage. And so the doctor gets, like, for example, gets $500 a month, but he'll make almost $2,000 a year extra from extra patients. So it's a great ROI, and we love businesses that can generate higher ROIs for their customers. That is a good alignment, and so I think you're going to be hearing a lot about how conversational AI and voice search is going to be a real theme in the future. And so that's what we think about.
Yeah, I think that's, and I want to get to one question here about, I think it's aimed at how you've had to amend your sort of due diligence process amid COVID. And I think that might be in the context of maybe LPs underwriting Honeycomb. But it could also be in the context of you guys trying to do your underwriting on specific companies, given that we're not meeting face to face. But before that, just real quick on conversational AI, I think what's interesting in the medical field with medical applications is to see how comfortable the collective community is with the error rates, right? If I say this vacuum sucks, how does the AI know that that's a good thing or a bad thing, right? And if in a medical context, right, it may be that a false positive is worse than false negative, or vice versa, right? If there's a small chance that it being wrong misdiagnoses somebody and leads to a fatality, what's that threshold? So I think it introduces some very interesting ethical questions. So I don't know if you have any comments on that, but I did want to, once you respond to that, if you can follow up on kind of shift gears just in here and talk about sort of how you guys are managing diligence process amidst COVID-19, that'd be helpful.
Yeah, well, look, let me just address that question because I can see it within Nuance's numbers. There's a business that was a transcription from radiology. Okay, so when you start having millions and millions of MRIs, absolutely AI is better. It is just better than the human eye saying this is what happened because they just have like that is not a growth profession based on what I see. Like it is becoming a commodity, and once you have enough of them, what will happen is actually it'll pop up when the doctor kind of uses the AI program. And if you went to Redmond, Washington, and you went to the healthcare room of the future that Microsoft shows in their healthcare vertical, they highlight Nuance and they say it's Microsoft's Azure that runs all the data crunching for this. And they take not just your MRI, but they compare it to the millions and millions and millions of MRIs. And they say, oh, within 99.9%, this is what this diagnosis is. So then you're going up against all the data versus your guy that says, well, I think you need to get a surgery. So I think that it'll get better. These are still, in the future things. And even now with the transcription business, the things that I thought were kind of interesting, like, many people in the medical profession have accents. And so having having this one company that just does it better is its own natural moat. So there are mistakes, but it's just better than having pen and paper mistakes too. So perfection is a long way out, but again, efficiency is how you have to look at the magnitude of order of change. And so, you got to start somewhere. So I think it's
that's
better.
a good point. Yeah. Go ahead. Do you want to address the sort of question?
Our diligence. I would tell you that it hasn't changed a lot. In fact, I think that the virtual conferences that we're doing are way more efficient. Waiting outside the one-on-one room for the next group to stop, so then you start. And we've done so many conferences, and our Zoom calls are just they're seven a day. During these the investment banks investment conference, and so I can see the team sign up for everything. And no, honestly, we're kind of getting filled on a lot. It's a little bit hard to say, no, you can't let you into that room. like there's only, right? I mean, it's a little bit like, well, why not? So I think that we're able to cover a lot more ground. I have not seen our diligence kind of fall off. I've seen us being able to kind of get a little bit deeper, a little more current. And then, the same thing that we do, whether we're talking to ex-employees or customers or all those things in the different channels that we have to kind of do our independent research on, those still exist. So even one thing that we're doing now, which I think we're going to probably execute an offer letter to, hiring has been something that, I think in the beginning of COVID, we were like, how can we possibly hire somebody for culture fit, for all these things? And then you do enough of these, and we do at Honeycomb, we do virtual happy hours, on Fridays, and we hang out and say, how was your week? And all the way you guys got going on this weekend. I made little tweaks where I said, okay, we've all been like dialing in, but I don't see anybody. So you kind of need to like show up and let's see each other because, there's, hundreds of different facial expressions, and that's what builds camaraderie and stuff. So, we have one guy that still hasn't come in, and so we're gonna see what his story is. But other than that guy, everybody else does show up. So I feel like it just took time to iterate. But look, work from home. Some of these trends are really going to be, I think, staying with us. And if you look at like one important bet that we have on in cable broadband, okay, cable broadband spend is up 9% year over year, and 1 gig speed is only 5% penetrated. So when my kids are here and they're all doing their online remote classes, we had to upgrade. We didn't have a choice. And frankly, the employer should pay for that. So if we can move something from being a consumer expense to a worker, a corporate expense, that's like the days of the 3 martini lunches, like we could really start seeing some phenomenal growth. So cable, I always go to as part of my recession playbook. You kick out your dog before you kick out your cable. But now with broadband, I think that it's going to even be better. So we can look for not only a potential re-rating of the free cash flow streams, but I think it's much more durable. And when we can find a business that isn't just going to, we think, recover, like let's say like online travel agencies, when eventually we do recover, which we're going to have some exposure to, but some of the durability of this cash flow, like a cable business, that's kind of how Honeycomb is positioned.
And talk about the negative side of things, right? So if you can comment on valuations broadly. I get asked about that. Lots of people get asked about valuations. can you talk about things maybe that you guys aren't constructive on right now that you know, maybe the biggest mistake investors or the most crowded trade that you think is likely to be wrong? You know, but maybe address some of that. I think that'd be interesting.
I mean, I'll just be controversial, but I think probably Apple. I mean, the thought that I know it's a $2 trillion company. I know it's amazing, but I'm looking at these headlines every day where we're just going after Chinese companies, and I mean, the Chinese are so smart. I just can't imagine that we're just going to let the App Store just sit there in China, take 30% vig off of all the Chinese companies, and that's not going to be a problem for some headline as we get closer to the election. So I don't think that seems like that's discounted. You know, we don't own Apple. It's a great company. It's a great management team. It's a great product. There's other ways to play the 5G cycle, but I think that there's certain, you know, retail-driven valuation things that don't totally make sense necessarily for us at the current valuation and market caps that I see about forward IRRs. And we just want, you know, low double-digit net returns, and if we get there, that's because we did our research right. So to buy Apple at $2 trillion, you know, what are you penciling out as your forward IRR, and what kind of political risks are there around it, and is it being discounted or not?
Mm-hmm. Well, I see Andrea on the screen, so I think that means our time is up. I mean, I apologize. There's a handful of questions that we weren't able to get to, and they're good questions. But David, I found it really fascinating. I mean,
oh, thanks.
I can't believe our time is up.
This was amazing. I mean,
fun. Yeah, it was fun.
Well, regarding the questions, there are more questions on this one, David, than we've had so far. So Donna and I will send them to you and to Dominique. And thank you, Dominique. You're out there listening, and you helped set this up. So we are grateful for that. And
we are at Honeycomb are very, very happy to be here. And the tech valuations are very high. So stay away from 20 times revenues companies was my other part of that Apple conversation. You know, like we are judicious about where we're finding our growth names.
So Mark, thank you for doing this for us, for always being our champion whenever we ask you to do anything. And it was great to have you on, David, and we're hoping to see you in person. But I'm really happy to hear that that you said you're doing well with the virtual events, because we're grateful that people are enjoying the virtual events. And like Donna said in the beginning, as much as we want to be together, it's just, we tried everything and we just can't do it. And I think many of you will probably thank us for not doing it now. I think there was some stress going on with some of our members that really wanted to come, but just didn't want to have to ask their husband or wife or kids, can I go? And so we just want to take the pressure off everybody. So we are going virtual October 26, 27, which the good news is that we will open it up to a lot of people on this call who want to participate. So if you're not a member, you actually can participate in that virtual conference. So we'll send you all the information, but we will have some very special treats for our members who have been supporting us through this whole thing. And one of them is that our members will get an opportunity, as long as we have enough allocators out there that will take one-on-one meetings with our managers members. We want to support our manager members and our sponsors who have been really great to us through the pandemic. So we want to make sure we can team you up with allocators, and we really need allocators out there to help us do that. So anything you can do to help us, we really appreciate it. And our next coffee break series, we are working on topic now and speakers. That's September 10th. And don't worry, members, you won't lose your 2 passes. You will still get it for all of 2021 if that's what you signed up for. You won't lose a thing. And anyway, thank you, everybody. Have a great rest of your week, and we'll look forward to seeing everybody soon. Thanks again, David. Thanks.
Be safe. Thank you.
Thanks, you too. Bye-bye.